Deepan, great speaking with you and appreciate your time here on CNBC as always. Thank you. Well, our alpha manager today is Aman Chowhan and he's fund manager at Abakkus Asset Management. He's joining us now to take some questions. Aman, great to have you with us here. Thank you very much for your time. What is the reading of Team Abakkus with what's going on in the market, Aman? There's a bit of sort of fear in the system. People drawing parallels to past financial panic episodes. What can happen? We don't know the full thing. What's your own reading?
Too early to take a call because what happened in the past, I'm sure, is not going to get repeated in the same way. So if we draw parallels to 0708, we all have learned from the mistake of 0708. So I don't think that same event is going to unfold this time. It's going to be something different. And that is what the uncertainty is all about, as to what exactly is going to unfold, which is making the market numbers. Markets don't like uncertainty, and that's this exact situation we are in today. So we are in the same boat. It's uncertain times. That's the reason we have not taken any bold stance, either to get very aggressive in the market or to be completely defensive. So continuing with our stance, wherever we find a decent opportunity, we are deploying cash, irrespective of the sector, irrespective of the overall market mood. So clearly going up bottom up at the current juncture.
So, where are you looking at these bottom-up bargains? I mean, I don't know if you can talk stocks, but otherwise, even in terms of just themes or ideas, what sort of stocks are you looking to pick?
So clearly, in the near term, we are not looking at companies which have an export focus, because we are also uncertain as to how the European and the US economy is going to shape up. Clearly, there is a slowdown there. What is uncertain is the extent of the slowdown, but I don't think anybody has a doubt that there's going to be a slowdown, or this slowdown is going to continue for some time. So that's a clear no-no. So domestic focused companies, inward looking companies is what we are focusing on, and sectors which will benefit out of the lower commodity prices. So say like cement, which will benefit from lower coal prices, or say some of the consumer names which can benefit from lower palm oil prices, lower agri products prices. So these are some of the sectors that we are focusing on. And banking, obviously, is something that is clearly inward focused, domestic growth led sector. And that is something which we are continuing to be positive on.
Okay. Would you hold off on your purchases? I know you like a few stocks and you would buy them irrespective of the sector, market, levels, etc. But broadly, is this the time to invest whatever you have to invest in those stocks at these levels? Or do you think lower levels are in store for our markets, and therefore, if you want to invest 100 rupees in stock A, you would invest only 10% right now?
I will invest 20% right now, and I'll wait for the balance. So it's not going. There's no tearing hurry, because frankly, it's not that we have valuations which are like too comforting that there's no downside risk. From here on, also markets or stocks can indeed correct anywhere from 5, 10, 15%, right? So it's not that we are trading at low single digit or low double digit margins, P ratios. So I'm not cautious, but yeah, definitely no tearing hurry to deploy.
Yeah, no, that's well put, Aman. No tearing hurry, no big compelling reason that I have to lock in this price, right? It's well put. And of course, I mean, one is valuations. The other is that beyond this bank weakness episode, and how that may pan out, the impact of the 500 basis points that rates have gone up in the Western world. I mean, that has yet to kind of show through in the economy, right? And that will lead to some growth hits everywhere.
Yes, so the initial impact is already visible, and going ahead, the full impact is going to be visible. But the market is aware of this. It's not that the market is going to be surprised seeing the impact of this 500 pips. It's more of a call as to how severe the damage is because of this rate hikes. Right? It's going to be a soft landing or a hard landing. That's what the market is trying to negotiate. An added element to this is that if there is a hard landing, then markets will be volatile in the near term, but the Fed will come in and either talk the market up, will say that no more rate hikes, will infuse some liquidity, and that is good news for equity markets. For the economy, it will still take time to get reflected, but the stock market will bounce back very sharply. And that's the dilemma managers like us face, that we can't be at the extreme side of being a buyer or being a seller, because even if there's a near-term volatility, it can happen that overnight US markets are up, overnight Fed makes a statement, Dow futures goes up, and tomorrow morning we can have a gap up or a gap down opening. So as I put in, it's uncertain times, and hence we are also feeling it pretty in a very neutral way, just staying put as to what we were doing a month or 2 months back, doing nothing great or nothing different as we speak.
We've already tasted what the impact of this 500 basis points rate hike in the US has been. Is there a possibility now of a very deep recession, a hard landing? Earlier, markets were contemplating with a soft landing, a technical recession. Do you think now
there was no landing.
No landing was also, one of, the scenarios. But do you think now there is a possibility of hard landing and growth rates will radically come off?
Chance, I'll say a lower probability of that. But if that happens, then I expect the Fed to counter that in a very meaningful way. So it's not going to be too severe for too long. Even if that happens, it's going to be maybe 1 or 2 quarters before the Fed starts to step.
Okay, thank you very much for joining in. Let's get to our segment, D Street Chat.